Okay, ladies and gentlemen, this is screen capture video number 4, and I'm going to go over the journal entries for J.P. Jones Plumbing Repairs. Alright, so how do we analyze these narratives which describe the transaction? So I gave you in the last video 3 steps. First thing is you ask yourself, what accounts were affected by the transaction? So on January 1, it says J.P. Jones invests additional personal funds in the business, $40,000. So the 2 accounts in play are cash and capital, which is the name for owner's equity in a sole proprietorship. All right, next question. What is the classification? In other words, which one of these are these 2 accounts? Well, cash is an asset and capital is just owner's equity, which I kind of use these terms interchangeably. And the next question is, well, is the account balance is going to go up or down as a result of this transaction? So if you just dropped $40,000 into a checking account, your balance just went up by $40,000. And your capital also increases by $40,000. So once we've worked this out, then we go to our rules, the rules that were developed by Luca Pacioli in the year 1500. We say cash, asset, I want to increase it. I'm going to debit cash. And capital is owner's equity, and I want to increase that. How do I do that? The credit capital, and there's our first transaction. I call these daily recurring journal entries, typically like a bookkeeping type activity. Okay, what happened? January 2nd, we purchased a store for $125,000. Allocating $100,000 to the building and $25,000 to the land. That's 2 separate assets. Land is an asset which would be kept separate from the building, which is an asset. Okay, now the breakdown was the land, we have what? $25,000 allocated to the land, and we have $100,000 allocated to the building. These are both assets. Yeah? Let me straighten this out a little bit before I go any further. Those are both assets. And you got more of them, yeah? So if I want to increase an asset account, I'm going to debit these accounts. Now, did I get this for free? You say, of course not. I had to pay for it. How did I pay for this? Well, cash, which is an asset, is decreasing by $50,000, and the difference looks like there's a $75,000 missing here. And what does it say? It says the remainder with a mortgage. So you look at your little chart of accounts on the top of the page, and sure enough, there it is. Mortgage, note, payable. So anything ending in the word payable is a liability, yeah? I want to increase the liability. I need a credit right there. Okay. What happened next? All right, January 3rd begins with that dirty 4-letter word, right? P-A-I-D. Whenever you see that word, you say, well, I got less of my favorite thing. And what is my favorite thing? Cash. So that's half of my transaction, $4,200. So highlighted, it says for the next 6 months, unlike problem 2.4a, which they failed to indicate the period covered. So when you see that, you say, all right, that's 6 months, that's in advance. When I pay a cost well in advance, I'm talking several months or more, I want to go to an account that begins with the P word. What word is that? Prepaid. Prepaid what? Prepaid insurance. What kind of an account is prepaid insurance? Prepaid insurance is an asset account. I want to debit it. Well, I had no choice, right? Because if you're going to credit cash, you need to debit something. So prepaid insurance is an asset. I want to increase it with a debit. And there it is. All right, moving right along. By the way, if we were just paying a monthly premium here, we just would have used insurance expense instead. That was not the case. On the 4th, what happened? We purchased supplies on account. We say, okay, I have more of what? I have more supplies. What kind of an account is supplies? It's an asset account. Did I pay for these supplies? No, it did not. It says on account. So when you buy something on account, you owe the money. That's going to be accounts payable. So part of our Chapter 2 study is to identify the transactions. And there you are. There you have purchased supplies on account. If it was equipment, it would be debit to equipment and a credit to accounts payable. All right, January 5th, what happened? Purchased equipment. What kind of an account is equipment? That's an asset account, yeah? We used that one in Chapter 1. The equipment cost $12,000. It says we paid in cash. Our favorite asset is now slip sliding away. We paid in cash $2,000. And what happened? The difference is a note. So the mention of the note, you go to the top of the page, and what do you find? Notes payable, which of course is a liability, and that's $10,000. Yeah? You want to increase the liability. You owe more money now. January 6th. Collected $8,000 from cash customers. Oh, good. Cash is my favorite asset, and I have more of it, $8,000. It says cash customers. That means you didn't bill them before. These are our favorite people, right? You do the work and you get the money. There's no waiting involved. That's going to be service revenue. Remember from the Jill Jones transactions, right? First bit of work that she did, she got $2,500, and we increased cash and we increased capital with fees earned. So here we are now in debit and credit land, same thing. Well, why did we credit service revenue? Well, for one reason is you had no choice because you already had a debit. And the other reason is what? If you want to increase revenue, you're going to need a credit. Yeah? Okay. What happened on the 8th? We returned supplies. We have less supplies now. Supplies is an asset. I want to credit supplies. How many supplies did we return? $120 worth. Okay, so what's the rule here? Supplies, asset, less of it. What do? Credit. What do we debit? Did we get a refund? No, we didn't pay for it. So what we're going to do is we're going to debit accounts payable to reduce the amount owed. Accounts payable being a liability, you want to reduce it, you use a debit. There you go. January 12th, paid. Credit cash. Okay, for how much? Well, $850 minus $120 sounds like $730. So, what do we debit? Oh, it says remaining amount. Remaining amount of what? Remaining amount in accounts payable. You want to reduce the amount by the supplies you returned, and in this case, by the amount of cash paid. 14th, billed customers on account. Okay, you did the work. You did the work and you billed the customer. So just from those two statements alone, we know that we've already earned the revenue. So you credit service revenue because you want to increase it. What do you debit? Did we get the money? No, we have to wait. That's going to be accounts receivable. Billed, charged, invoiced customers, clients on account is going to be this kind of a transaction, which happens a billion times every day. All right, 17th, what happens? Starts with that dirty four-letter word again, right? Credit cash, $850. Let's see now. Do we have golf club expense on the top of the page? You say no. That's obviously personal use of company funds. That's going to be drawing. Personally used company funds. Why did we debit drawing? We want to increase drawing. Those are the rules. Okay. 19th, what happened? Receive cash from customers on account. Well, the first two words tell you what? I got more cash. I'm loving it, right? And what did I get? 5,500. Customers on account. Those are people you already billed, as in this transaction. So there's the earnings being recorded, and now we are recording the what? The collecting. So what you don't want to do on the 19th is credit service revenue, because that already happened. This is just collecting the money that's due. All right. 20th, what happened? Well, we gave credit to a customer on account for an exploded sink which had previously been installed and billed. You see anything in there that says we gave them a refund? We did not. So when there's some type of malfunction in the earnings process, then you're going to do something that's somewhat unusual. You hope it's unusual, right? You want to reduce revenue. Why? We want to reduce revenue because we screwed up, right? $650 worth. Now, if the customer or client had already paid, we'd be crediting cash here because we'd be issuing a refund. This customer did not pay. So what are we going to do? We're going to reduce the amount that this customer owes by crediting accounts receivable. Why do you want to credit accounts receivable? You got less of it now. Yeah? So if you look at that transaction, it's the exact opposite of billed customer on account. Again, that's unusual to debit a revenue account, and you certainly in the real world you don't want to be doing that a lot because that means you're messing up a lot. All right, 25th, what happened? Starts with that word again, doesn't it? Credit cash. For how much? $1.65. It tells you what to debit. Miscellaneous expenses. Why did we debit the expense account? A, we had no choice. B, if you want to increase an expense account, you want to go with a debit. 26th, receive the telephone bill. It's going to pay it next month, which is February, $225. This is the exact same transaction we had in the very first worksheet we did for Jill Jones. Let's see, who did we get this bill from? Telephone, okay? That sounds like a cost of doing business. Telephone expense. Yeah? You want to increase it. Did we pay? No, we didn't pay. We owe the money. If you owe the money, you want to go with accounts payable. So here you have an expense paid in cash, and here you have an expense which you're not paying, but you incurred the expense, you used the phone, you got the bill, you record the expense. Next on the hit parade, January 30th, received $725 from Professor Weinstein for rental of a 9 square foot area next to the dumpster. That'd be 3 feet by 3 feet. Okay, debit your favorite account, cash, right? Cash asset, more of it. Now, what is this, you say? Rental. I look on the top of the page, and what do I find? Rental income. What kind of account is that? Well, it's just like a revenue account. You want to increase it, you need a credit. $725. Next. Paid truck expenses. Well, that's the exact same deal as this here, right? An expense paid in cash. So it's going to be the same format. This is going to be what? Truck expense. Credit cash $425. Zip, zip. Debit the expense, got more of it. Credit your favorite asset, you got less of it. And finally, what happened now? Received $1,500 advance payment. Installation is going to be performed in March, and we're in January. So we debit our favorite account because we got more of it. $1,500. Did we earn the money? You say no. We didn't earn the money. We just got it. We're not going to do the work till March. So you go and you look at your chart of accounts. I'm referring to this as a chart of accounts up here. You look at your chart of accounts and you say, well, what would be appropriate? Looks like unearned fees is a winner, right? Because I didn't earn this money. By the way, I've used that term a couple of times. A chart of accounts is nothing more than a listing of accounts that are in your ledger. And I don't want to stifle your creativity, but when you have a problem like this and you're given all these accounts, you should find in here somewhere the account that pertains to your transaction. So you don't have to make them up on the fly. Okay, where are we now? We're down here. We want unearned fees as a credit. Now we saw that in 2.4a. I believe it was unearned rent, something about a parking lot. So what kind of an account is unearned anything? That's a liability account. You got more of it. It doesn't end in the word payable because you're not going to pay, but you are obligated to do something. In this case, to do work. $1,500. Unearned anything is a liability account. And there you have it. So we have all of our transactions. Hopefully they compare favorably to your work. And the next step is the posting. Now posting, you're taking these transactions that you wrote down in a journal and you are transferring the information to the ledger. And that is called posting. In the old days it was done manually, which is basically what we're going to do here. Okay, when you use a computer, this is happening in a millisecond. All right, so what's happening with the computer? All right, let's look at the few of these transactions. Do we know which account to go to here? I hope so. It says cash and we got more of it. So I want to go to my cash account and I want to drop that in on the debit side. That's 40,000, right? If I want, I could put the date here, yeah, January 1st. Now, I put the balances in the account in these little blue rectangles. I also have over here a trial balance as of January 1st. So once again, what's a trial balance? It is a listing of the accounts that you have in your ledger and the corresponding balances. So we have these balances in the ledger as of January 1st, and now we are doing the transactions for January. So you will find all of these amounts here in the little blue boxes to distinguish them from transactions. Okay, what else happened with that first transaction? It was a credit to capital, yeah? So you put it on the credit side. Zip, zip. We have recorded, or we have posted rather, the first transaction. So we go to the second transaction. What happened? We debited land and we debited building. It's two separate accounts. As we're going to learn in chapter 3, land does not depreciate, building does. All right, but in any event, you want to increase these two assets. It tells you what to do. Go to land, put it on the debit side, the left side. 25,000. January 2nd. Go to building. Put it on the debit side. Okay, what else happened? It was a credit to cash because we made a $50,000 payment. So put it on the credit side. and there was also a credit to mortgage payable, and that was what? That was 75,000, right? Okay, so we posted the second transaction into our ledger. Okay, I'll do one more, because I don't want to take all the fun away from you, all right? January 3rd, PAID, what is that transaction again? It was a debit to prepaid insurance, it was a credit to cash. Now, all the hard work in terms of analysis and whatnot was done when we made these entries here. This is where the hard work is. This is where the thinking is involved, okay? What I'm doing right now is very mechanical. Doesn't mean that it's not easy to screw up. It's just mechanical. All right, where are we? We want to credit cash for what? For 4,200. It was on January 3rd. And the debit was to prepaid insurance. And that was 4,200. And that was on January 3rd. Okay. So now we all have the correct transactions here. So I wanted to show you this first before we did this posting activity, because I didn't want you to be posting the wrong entries. So now we have the correct entries and we're posting them and we're going through this process. All right, now most of the accounts are not going to have a lot of activity. Cash will have a lot of activity because there were numerous collections during the month, okay? And there was a bunch of payments. So when you get to the end of the month, when you've posted everything, you want to add up the debit side, including the beginning balance. You say, of course, right? You knew that, right? Add up the debit side, including the beginning balance. Add up the credit side. Doesn't have a beginning balance, but I'll do the whole thing anyway. So you got 62,250 in debits, and you got 54,200 in credits. You have more debits than credits. Whoops. So we got, I'll figure it out in just a second here. 62,250 minus 54,200. At this point on January 3rd, we have a balance of 8,050 in cash. So you're going to have a bunch more transactions. That's not going to be the ending balance. But that's how you do it. You add up the debit side, you add up the credit side. Which side is larger? For the cash account, you certainly hope it's a debit balance. If you have a credit balance, what does that mean? It means you're overdrawn. Okay. All right. That's how you do it. Now, having done all of that, and this would be the most difficult account, cash, you would then take these ending balances that you have computed, and you would prepare another trial balance, and this is where you might have some empathy for the old-time bookkeepers that did this manually. So I have a spot down here where you can do that. So once you figure out what's the ending cash, I'll just pick a bogus number. Say the ending cash is $61,000. That's what you computed. That number goes over here. And then you put all the other numbers in. So these should all have debit balances because they're all assets, right? Up to equipment. They should all be debit balances, yeah. You could have a credit balance in cash, but can you have a credit balance in building? Only if you messed up, right? Because that would be antimatter. Anyway, those would all be debits. Then you got the payables, that's going to be a credit. Unearned, that's going to be a credit. Notes payable is going to be a credit. And mortgage payable is going to be a credit. Capital is going to be a credit. And then drawing will be a debit. The revenue and incomes will be credits. And the expenses will all be debitos. Yeah. And then if after you've done that, you're hoping against hope that what? that the sum of the debit balances is equal to the sum of the credit balances. And that's why this was called in the old days, and the name is still used, it was called a trial balance because it didn't necessarily work. And so in the old days, pre-computers, right, bookkeeper would have to go back and find out where the mistake was. And that's what we want to do. So, what is your mission? Your mission is to compare your work to the journal here. All right. I've gotten a few questions about comprehensive assignments, and you're going to have a problem just like this one where you have to prepare the journal entries. So you got to ask yourself, could I prepare similar journal entries for a different problem? So that would be one of our problems in the comprehensive assignment, which I plan on sending out to you 1 week from today, which I believe is October 2nd. Okay, that's my plan. And then I plan on collecting those assignments by Monday, October 5th. Okay, so this is going to be one of the things that you need to do. Okay, so do that, post it over here, take a shot at your trial balance, hopefully it works out, and I will, of course, send you the final Jeopardy answers for the trial balance and the ledger and all that. Okay, so compare your work to this, and where you do not understand where it differs, you should definitely send me an email and I will address that issue for you. Okay, this is very important. What do the IT professionals say? They say garbage in, garbage out. So if these are wrong, then everything else that follows will be wrong. That's the bad news. The good news is if these journal entries are correct, then everything that follows will be correct. Okay, with respect to these transactions. Okay, another thing I should mention. When we have our January 31st trial balance, which contains all of the transactions from January, is that a financial statement? It is not a financial statement. So this will be the raw materials for our financial statements. You say, what financial statements? The ones we did in Chapter 1. The income statement, the statement of owner's equity, and the balance sheet. But these are not the final numbers, as we will discover on Monday when I go over adjusting journal entries. So some of these balances are going to have to be modified, okay? We're going to come to know and love those modifications as adjusting journal entries. So for the time being, let's see if we can come up with this trial balance. And then on Monday, I will describe certain situations which need to be addressed as we learn about adjusting journal entries. They are journal entries, so they're going to look just like these. It's going to be debits and credits and whatnot, but they're special. They're more accounting type journal entries. So it's hard to generalize to say that these are bookkeeping entries, so that's a generalization. And to say that adjusting journal entries are typically done by an accountant as opposed to a bookkeeper is a generalization. But that's kind of where we segregate these activities. Anyway, that's it for now. And there'll be more information about the submission of the comprehensive assignment during this coming week and so forth. Any questions, you know what to do. I'm here to answer them. Have fun.